it going, guys? Welcome back to the Capital Mindset Show. Today, we're going to be doing yet another subscriber request. This time, it's going to be the Viacom CBS turned now into Paramount. Okay, so they did a name change. They fell on the announcement of the name change. We're going to be discussing that. So I guess first we begin with the price action, not to waste anyone's time. And let's actually discuss this over the longer term. It's not been a good performer. It's been a severe underperformer when compared to the market. You would have been way better off investing in index funds. However, I want to highlight this. So if you had timed the market beautifully, because you're a genius, you would have made about 1,400%, severely outperforming the broader indexes. So in that time period, because you're just a Chad and you timed exactly when to buy it. So some people might have done that, okay, but that's not the point. That was more of a joke. What I want to actually highlight is this right here. This was actually a hedge fund that blew up. It's no longer with us, for those of you who are saddened by that. And now we're actually seeing a return to normalcy and actually perhaps maybe undervaluation. We'll actually take a look at that, but they are below pre-pandemic levels. They have a nice, interesting library of content. So we don't want to discount them like that right off the bat. They are trading cheaply on a PE basis. However, as we'll take a look on the model, we may find a different story, right, to tell. Okay, so taking a look at the model, let's actually go right in and let's type her in. Okay, as she loads in, and we see a price target of 45.24, implying 59.41% upside. Required rate of return, we just put it at 10%. So basically, if this does not grow, we are not in favorable terms at the present moment. And as we can see here, the PE being a 4, but the price to free cash flow being at around a 28.75. Let's take a look and see if there's something crazy going on here. So yes, right here, right off the bat, I see that the cash flows are extraordinarily low in the present moment. I do think that that's going to be followed by a quick recovery. So what that means is up here, we're going to actually imply a recovery portion or a recovery percentage. And so we're not going to actually assume that the baseline is right now. Okay. And if we take a look at what we don't have any access to estimates in the present, by the way, that's why you actually don't see the estimate amount, because this is technically a quote unquote new company with a new name and everything. So we still have to aggregate that data appropriately. So taking a look at the return on assets, return on equity, those are pretty good. Ignore the book value because that's not going to aggregate at the present moment, because again, as this name change just recently occurred, we have to wait a couple of days for the data to actually properly aggregate. All right. So, and we see, okay, so in Altman Z-score, this is actually one thing I want to actually talk about. It actually has a lot of risk implicit in the business. We actually can see that by the market cap to enterprise value. So I can already tell they have a lot of debt. Then the Altman Z-score speeding that up. So it's actually saying this is at risk. Well, it's actually ambiguous. It's actually in the ambiguous range. And it's also triggering ambiguity in the other models version of the same thing. All right. And it's saying it doesn't know. Okay. Because it doesn't say yes. It doesn't say no. It doesn't know. Okay. Now taking a look here, let's actually assume some growth rate. So implying a recovery, I think 20% is actually 20% actually supposed to be here, not there. 20%. Remember, we're applying a recovery. I just want everyone to know that. They're like, oh, 20%, that's a lot. No, I'm implying a recovery rate. So that's why it seems high. And then a 15% down the middle. So we're actually right there, priced for 15%. And we're market average rate of return. And then I think a 25% implies, recovery rate and then some. And then again, we're only asking for a 10% required rate of return, 10% down there, and then 5% down there. So here, just on this, the model is saying, okay, based on all these risks, blah, 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 2.86% is what the model is suggesting. Do we trust that like a religion? No, we make our own assumptions, our own opinions. Okay. But that's good to note. Taking a look at the RRR, let's actually increase that, give ourselves a nice margin of safety. We already see how immediately it comes down, our assumptions. So we have to actually wait for it to come down a little bit more before we can assume that 20% growth rate. And again, that is implying a recovery growth rate. I want to be very clear on that. Because I know I'm going to probably put chapters here and people will skip over. So I have to repeat some things sometimes. So I apologize for that. All right. So let's take a look at the key ratios and kind of finalize our thoughts here and then close out or closing statements. So with the current ratio, the liquidity ratios, they look pretty good. We want to see the current ratio again above 1. Cash ratio, I'm not going to hurt them for being, below 1, but they're close enough. However, it appears that that's more in line with more recent times. So they're actually accumulating cash now rather than before. Looking at the solvency ratios, I see that debt is, we saw that it is a problem relative to like the actual market cap, but they are trying to resolve that. And I guess relative to their assets, it's not actually that much. But remember that their assets are a lot of intangibles. So we want to be very careful how we kind of take that. We want to take that with a little bit of grain of salt. Looking at the DuPont analysis, we see, decent gross margins. I actually want to see those gross margins increase. They are in the content space. I want to see those margins increase. We should see those increase as they move to a more streaming service. Net profit and operating margins. Okay, we want to see the operating margins definitely rise. That's pretty bad. Net profit margin though is decent, and again, that's on a GAAP basis. But we see that the cash flows are down in the more recent year. ROE, okay, that's okay. That's pretty good. Let's take a look at the cash flows. So the cash flows are pretty, not the cash flows, sorry. I meant earnings quality. Earnings quality is pretty bad. If you ask me, it's always below 1. So indicative of not that well run of a business, if you ask me. Okay, and that's kind of shown in the stock price. So over this period of time, it's not being well run. However, going forward, that can change. Okay, that can change, but just note that in the past 5 years, it hasn't been well run. That's what that is telling me. We're going to ignore the activity ratios because they're not really selling inventory. Okay, so taking a look over here, back to the summary report, I think this company is getting interesting. The price has to come down for me to start to really take it seriously. I have Discovery in my portfolio. Again, my portfolio is public for everyone to see. So Discovery is in the portfolio. Paramount is not. I made my choice at the moment. And so far I'm doing pretty well on my Discovery position. Actually, I haven't even checked what Discovery is. So actually, let's actually just plug her in there to kind of see. Yeah, so I'm up decently on Discovery. Ignore these growth rates, by the way. And for Discovery, there are some added nuances in terms of the share count. So ignore these, right? These are not adjusted. So, so before you guys get excited and go, oh, look at that. No, it's got to get some adjustments in there. So going back to Paramount though, it's a company in the streaming space. Whether or not it's going to be successful is, up in question for me personally. So I'm not interested really in Paramount, but at a certain price, I think it can be very compelling. If we see like a crazy correction back where it was during the pandemic, I think that is a really good price where a lot of risk is priced in. All right. On that note, guys, if you guys like content like this, go ahead and feel free to leave a like. If you guys want to see more, go ahead and subscribe if you're not subscribed, and then come back and see if your stock is being talked about, or if you have a request, go ahead and leave it down in the comments below. And again, I'll add it to the list. I should be able to get more and more requests out at the present moment. I will be changing how I take requests because now, they're getting to a point where it is a lot. But for the meantime, while I'm doing this, I have this new system and it helps me do it a lot faster, a lot better. All right, guys, I hope you guys have a great one. I'll see you guys in the next one.